Hey, welcome back. So today we are diving into a huge question, one that's right at the center of, well, everything, but we almost never stop to think about it. What is money? Seriously, not how to get more of it, but what is it, really? We're about to unpack the massive difference between the money our ancestors used and the money that's in your bank account right now.
Okay, so let's just start with this bombshell of a quote from our source material. It's pretty intense, right? It suggests that maybe, just maybe, our whole idea of wealth is built on something a little shaky. Sounds dramatic, I know, but trust me, it perfectly sets the stage for what we're about to get into.
So let's just ask the question straight up. That number you see on your banking app, those bills in your wallet, what actually gives them value? Is it real, or is it just a kind of shared belief, an illusion we all agree to? Well, to figure that out, we have to take a trip back in time.
To really get a handle on the potential illusion of today's money, we've got to rewind the clock and understand what real money was, and why we even invented it in the first place. This story, believe it or not, starts thousands of years ago.
So at the very beginning, all we had was barter. Super simple. I've got some chickens, you've got some wheat, cool, let's trade. But there was a huge problem, what economists call the double coincidence of wants. Basically, I had to find someone who not only had the wheat I needed, but who also just so happened to want my chickens right then and there. It was a massive headache. So people got creative and moved to commodity money, using things that had their own value, like grain or salt. A good step, but even that had its issues, which led to the big game changer, metal coins.
And this slide shows you exactly why metals, especially gold and silver, completely took over and became the money of choice for centuries. I mean, think about it. Grain rots, gold doesn't. Cattle are kind of hard to carry around, but you can fit a ton of value in a small, portable coin. Best of all, pretty much everyone everywhere agreed that gold and silver were valuable. They just worked. They solved all the problems of the earlier systems.
So, for thousands of years, money was a real physical thing. But lugging around bags of heavy metal was, well, inconvenient and risky. This led to the next giant leap in our story, the invention of paper currency. And this, right here, is where the first cracks in the system started to show up.
Now here's the absolute key thing you have to understand. For most of its life, paper money was really just a claim check. It was a promise. You could literally walk into a bank, slap your paper note on the counter, and walk out with actual physical gold or silver. The paper itself wasn't the value, it was just a super convenient stand-in for the real stuff locked away in a vault.
But here's the thing. Governments throughout history always run into the same temptation. When they need cash for a war or for some big project, and they can't just find more gold, they get sneaky. They resort to debasement. The Roman Empire was famous for this. They'd melt down their silver coins and mix in cheaper metals, so they could make more coins, but each one had less real silver. It was basically the original version of printing money, and spoiler alert, it always ended badly. And that same old story of debasement just got a modern update. The link between paper and gold wasn't snapped in one go. It was slowly chipped away. First, governments told their own people, nope, you can't trade your paper for gold anymore. Then, after World War II, a new system called Bretton Woods made the US dollar the king of all currencies, but now only other governments could swap their dollars for US gold. This whole setup was just paving the way for the final decisive break.
Which brings us to a single day that changed the entire modern world, August 15th, 1971. On that day, President Nixon went on TV and announced that the US was slamming the gold window shut, period. Other countries were cashing in their dollars for gold, the US was running low, so they just ended the whole thing. And with that one announcement, the promise that had backed the entire global financial system was officially broken.
And that move plunged us into the era we're still in today, the age of pure fiat currency. The term fiat comes from Latin, and it basically means let it be done. Money is now money simply because the government says so. It's not a claim check for gold anymore. Its value comes from one thing and one thing only, our collective faith and trust in the government that issues it.
So, for the last 50-something years, the entire world has been part of this massive financial experiment. What happens when money isn't tied to anything real or physical? Well, let's look at some of the consequences.
Okay, check this out, because this is one of the most clever and important changes that happened. The very definition of inflation got flipped on its head. It used to mean the cause and expansion of the money supply. Now we're all taught that inflation is the effect, rising prices. It's a really subtle switch, but it's powerful. It makes us blame businesses for raising prices instead of looking at the source.
It's kind of like focusing on the thermometer during a fever instead of asking what infection is causing it.
And if you want to see the result of that infection in one shocking number, here it is. When you measure the US dollar against the one thing it used to be backed by, gold, it has lost almost all of its value. An ounce of gold that went for about $35 back in 1971 now costs thousands. It's not that gold got magically more valuable, it's that the dollar you used to buy it got weaker, a lot weaker.
And this system has led to some pretty predictable results, right? We now live with chronic inflation, this constant slow bleed on our savings that acts like a hidden tax. It has allowed governments to run up debts that would have been unimaginable in the past. And all that new money has to go somewhere, so it creates these massive bubbles in stocks and housing that eventually pop. The whole thing is built on confidence, and, well, confidence can be a very fragile thing.
Now look, the point of all this isn't to be a downer. It's about being realistic. It's about understanding the rules of the game we're all playing. It's about knowing the difference between real money and, well, the illusion of money.
So, in the end, the core message from our sources isn't some hot stock tip or a get-rich-quick scheme. It's actually something much more powerful. It's a call to action. Educate yourself. Study the history. Understand the very nature of the money you work so hard for. Because that knowledge, that's the most valuable asset you can have. And that really leaves us with the big question to think about, doesn't it? We've gone from trading chickens to using gold to trusting paper promises, and now we just have digital numbers on a screen. In a world of digital illusions, where promises have a history of being broken, what is real? What has lasting value? That's the question I want to leave with you. What will you trust to carry your hard work into the future?